Hi guys, I wanted to make a video talking about what a quality stock is. Not quality stock, a quality business is rather. If it's a quality business, the stock, in other words, will be a quality stock over the long term. A moat, a barrier to make entry that enables sustainable value creation by the business. Okay, Charlie Munger's quotes here. Or well, his thoughts, quotes, yeah, whatever you want to call it. Something the customer receives, like brand power, for example. You have companies like Apple, Nike, Coca-Cola. It's probably the famous one. The brand symbolizes qualities that the customer likes. Also, a moat can be high switching costs. I would call one of my investments Fortinet, or even Microsoft has this moat. Like, if a big business want to switch from them, there's a high cost. You have to train personnel to the new programs and so on. Then another moat would be a network effect. We could say, for example, MasterCard, Visa. If you start using MasterCard for all your purchases, you're very unlikely to switch to something else. Unless you get, like, there is no chance. Like, they have you locked for life, basically. And then you have a moat that I wouldn't necessarily see as a good thing in many businesses, but cost leadership. Like, they always have their cost lower. I would say the best example of this, where it's actually a quality, would be Costco, which was one of Charlie's favorite companies. Because of the membership fee, they were able to keep costs low, and they have recurring revenue. I'll go to that later. And the last moat that I would say is more questionable, and I wouldn't invest into a company like this, it would be patents and IPs. Patents can be easily, this is a thing with technology. Like, new technology will come out, improvement will come out, and competitors will challenge it. So, for example, I will probably not make a large investment in something like Nvidia, for example, but there's other reasons because of that as well. Okay, so that's point number one, moat. And then we have something else that you'll find if you read this book. Okay, it's a very nice book. I highly recommend it if you're a new investor. But you kind of need to know, you still need to know all the financial terms to be able to understand most of, especially if you go down to accounting books like Terry Smith's accounting book, Accounting for Growth. Yeah, so you still need to learn stuff like that. So point number two, consistently highly profitable companies. And I would like to add predictably. Like, if they're predictable and they're consistent, that would be the ideal company. So I don't remember what year, but it's around 50 years ago. Buffett mentioned in one of his, I think it was partnership letters. I don't actually know if it was in the partnership letters or if it was one of the annual reports from Berkshire Hathaway. But he looks at return on invested capital, and he would basically put a company into the hard pile if a company had 1 year where return on invested capital went below 10%. So he wants a consistent return on capital. And I want to add something to this as well. If you take a company's WACC, see, I'll change green WACC. So say, for example, Fortinet WACC is 9.5%. That's the working capital. So if you take return on invested capital is 25.57 out, 25.5. Okay, so calculator, we take 25.5 minus 9.5. So if you would buy Fortinet at a fair value, you could expect, if this return on invested capital and the working average cost of capital, you could expect a 16% return from this business if you paid a fair value, and it will keep these metrics stable, so to say. Yeah. And also Buffett, he basically says 10% on all businesses is WACC. That's his baseline, so to say. It's 10%. So it's roughly correct. But yeah, you can just... So that's why return on invested capital is so important, because Charlie Munger said online, if a business earns 8% on capital, so it's return on invested capital he's talking about, over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a hell of a result. So we should listen to this. Like, both Charlie and Buffett said this. And if you look at his biggest investments, this has been like a consistent thing. He's always want a company with, I would say, about 15%, and he would never want a company that's dipped below 10, because that means that's a 1 year where the company is not making a good return. Yeah. Also, on top of that, with the high profitability, I would like to cover high gross and operating margins, and you can compare this to their competitors. That's also a good way to see who's more efficient as a business. I'll actually show another thing that I learned from Warren Buffett. You can compare businesses. You can compare businesses like Tesla is below 300. If you read my post and you put a stop loss at 400, I saved you 25%. So say thank you in the comments below here. Anyways, if we go and we see property, plant and equipment, this is something I learned by reading all of Buffett's letters and so on. He looks at the property, plant, equipment, and he compares it to the operating income. So say he has two competitors that, I don't know, Coke and Pepsi, for example. They're not really Pepsi is more salt. But anyways, he compares them looking at how efficient they're using their property and plant, and what kind of operational income they get from those assets. So you can have competitors that have, for example, I can't think of anything now, but you can have competitors that have 1/3 of the property and plant, but still produce similar, or some cases even more, operational profits. So that tells you a lot about the company compared to its competitor. This is one thing, but it's specific for sectors as well. And then I would also like to highlight, when we're on profitability, is how important cash flow is. This is something I've seen, like even cash flow when it comes to evaluating businesses and predicting the long term. Buffett looks a lot on how the cash flow is actually produced, and we can read a quote from Charlie. Intrinsic value, the present value of future cash flow. So that's all you need to know. That's all you need to know if you want to evaluate a company. Understand the future cash flow. I've seen this Buffett, he likes to buy companies above 5% free cash flow yield. And I say this is a good outline to have in mind. At the end of the day, quality outranks valuation, in my opinion, but you kind of want both. If you have both, it's a double whammy, but we'll go over valuation in another video. So that's point number 2. Okay, so now let's go to number 3, resilient and growing revenues. Okay, what do I mean with resilient? I mean stable. Even in market downturns, you want the company to increase its revenue. And this is something that's heavily overlooked by a lot of investors, I feel like. Come so much far ahead if you have a company that's able to grow its revenue during, for example, COVID, compared to a company that have a major setback. And with this comes the, maybe not so easy to understand, but recurring revenues. We're talking subscriptions, we're talking services like rating agencies. The more recurring a revenue is, the easier it is to predict. The more stable it is, the more resilient it is. So we like the recurring revenue. Also, we like it if it has a second catalyst that can push the revenue higher. as well as something else, but low cyclicality of the revenue. Yeah, like I said, in a downturn, you don't want the revenue to be punished. Is the balance sheet. You want a healthy company. And the balance sheet basically tells you if it's a healthy company or if it's highly leveraged, and if you have like management that take advantage of shareholders. You have, for example, you have shareholder equity on the balance sheet. That's one thing you can check out. It tells you a lot about what you actually own as a shareholder after all the debts and so on. So you want, I would say, a reasonable level of debt. Almost every company has that. So you want a strong interest cover ratio, but it's basically measures the company ability to pay its interest expenses with its operating profit. It's a good indicator for financial health, and of course you preferably like a management that uses the cash the company produces. So I don't actually like to see a company have a lot of cash unless I know they are going to use that cash for buybacks. Like in the case of Evo that I bought, I know that, oh gosh, what was his name? The billionaire who bought into Evo, he will push for a share buyback plan. And the cash that's in the reserves will be used for that. So in that case, I'm okay with them having a lot of cash because I know it's gonna be used for share repurchases, which will pay me as the shareholder. So you don't want a lot of cash by the sidelines just sitting doing nothing. Okay, so that's point 4. Basically balance sheet. Check the balance sheet. Okay, so number 5 I would say is efficient capital allocation. You can do a lot of different things with the capital in the business. You can have research and development, expansion, acquisitions. I prefer to not have a company that requires acquisition to grow. That's why I'm not that bullish on Microsoft, for example, even though they have a proven track record. But they depend a lot on acquisitions. But their legacy business is still growing. So yeah, take it with a grain of salt there. But yeah. So there are different things they can do. Of course, share buybacks and dividends are very popular. We like those, especially if the company is undervalued. I love share buybacks. But the problem is with businesses that keep on buying shares even when the company is overvalued. And that's the hard part. They need a smart dividend and buyback policy. And that's for the next point. Competitive and, I wouldn't really say smart, but logical management. I would say that, yeah, logical management. You could say founder-led could be a good thing. It could also be a bad thing if there are some real crazy founders out there. But you want a management that is long-term focused and shareholder focused. After all, these people will lead your business. They will make all the decisions of where all the cash flow and investors' money will go, so to say. So they will decide what kind of return you will get, basically. If you have awful management that overspends on compensation, makes bad acquisitions that loses value over time, then you're gonna have a lousy investment, no matter if you buy Microsoft or Apple or like whatever big tech you buy. So I would say skin in the game is quite important as well. If you have a management that actually buys shares or already owns a large chunk, that could help them make better decisions, because then they're themselves involved with getting a good return on their assets, so to say. So you could also look at the track record, if they made good strategic decisions or if they actually lost. I would say one thing I noticed just a few days ago, AMD, they bought some company or something for 4.9 billion, and now they look to sell it for 3 to 4 billion, if I understand it correctly. That's something that I would put up as a red flag. If I were an investor, I would ask why they're doing it, why they bought it in the first place. That would be my question. And on top of that, the upside is their margins will improve when they done this, when they sold it off. The downside is management bought this for 4.9 and now they want to sell it for 4. That's not a good sign, in my view. They're not really respecting the shareholder, I feel like, when I read that. Okay, so, and then we go to another point, the industry, because you have the company and then the industry it competes in. So some industries have secular growth trends. For example, they're moving to cloud. They have innovation that affects that sector, for example. They might be moving from a local or one country into a global scene. And I think the large one is, can they use pricing power without losing market share? I think FICO is the clear example here. They basically doubled their price every year. But the thing is, they got paid maybe $1 for when a person wants to take a loan for, say, $1 million, and then the person that wants to secure that loan has to pay $1. Okay, next year is $2. Next year it's $4. Okay, will they care if it goes from $1 to $4 when it's 1 million? Like the loan is 1 million. Do they care if it's a $4 fee from FICO, or like, okay, the price has gone up, but it's very cheap to start with, you know? So FICO is an excellent business when it comes to pricing power. And even when they saw a dip in market share, but in customers, the revenue keep on climbing because they just keep on increasing the price. So that's also a sign of a really high quality company. Yeah, I hope you like this video. I try to keep it as short and as straight on as possible. Basically things I look for when I want to invest into a company. Of course, not every company can be pure play on high quality, because most of the high quality companies are just ridiculously overvalued, but there will be a time when they are very cheap, and I will be buying when they are very cheap, and I hope you will as well. So, well, what can I say? Read this book, I recommend it. This is okay. It's good if you're a new investor, I guess. You have a short explanation on this page, it's quite important. Short, not like explaining all the mental models that Charlie Munger uses, and explaining all the terms like liquidation value and so on, if you don't know what that means. Production surplus, market value, real return versus relative returns, return on capital, return on equity, all the terminology means, so to say. It has a lot of nice explanation on that. Yeah, and it goes over the thinking of that. And of course, the most boring book as a value investor. I would say everyone needs to read chapter 8. Yeah, that's about it for the intelligent investor. I could recommend this book as well. Deep Simplicity fits with my channel name, so yeah, maybe you'll learn something about how simple the world actually is and how everything is. It seems so complicated, but it's not really that complicated, the world. But it's not really an investing book. It's just very, very interesting. Yeah, sorry, I'm going off track. Hope you liked the video. Goodbye.